Hello my friends and welcome back after Christmas. I hope you had a wonderful Christmas day with your family if that was possible for you, and a great Boxing Day. And I've got to say right off the bat here, from my Canadian friends and subscribers, I do apologize. I got so many comments on Friday and over the weekend saying, "We know what Boxing Day is, Neil." I meant to say it was the Americans. For some reason I thought Canadians didn't know as well what Boxing Day was. So with that said, let's get into today's video then. We're going to go over a lot of economic data, some very interesting statistics here. I'm just going to summarize a lot of stuff. So we're going to spend most of today's video on the shared screen. So let's go straight over there now then. So I want to start with this article then, which I talked about a couple of weeks ago, and we're going to link it to a lot of stuff today. But this was about how household debt has now surpassed $16.5 trillion, with credit card balances hitting a record high. So what I was expecting this Christmas time then was for a lot of, and I think it was going to be very, very split down the middle. You would have a lot of families that cut down on their spending, and you would have a lot of other families that would just put it all on credit cards. And that's exactly what we have seen. As Americans struggle with high inflation, rising interest rates, household debt has continued to grow. It actually increased 350 billion to make it 16.5 trillion, which is absolutely huge. And these were in mortgages, auto loans, and credit cards. Why these three? Well, it's mainly about interest rates for the first two in orange here. So as the interest rates have gone up, mortgages have become more expensive, and the same applies to auto loans. Now, auto loans actually has another metric with it, which is supply chain breakdowns, microchip shortages and other things, which has made auto loans more expensive, or should I say made the cars more expensive and also made the loans more expensive. Now, with the credit cards, this is purely as a result of inflation. People just couldn't keep up with the amount of very, very decades high inflation. So people have put it onto credit cards. And this is why we've seen this credit card balance surge at the highest rate in 20 years. The article says the 15% year-over-year increase in credit card balances represents the largest in more than 20 years. Now, the average interest rate is 16.27%. So this was as at August, which is the highest level since it began collecting data in 1994. And then we have mortgage balances rise $1 trillion from last year. Again, that is because house prices have obviously risen dramatically over the last 2 years, and interest rates have now gone up. So you basically got the worst of all worlds here. So let's take a look then at this article on what happened with retail sales during the holidays. So retail sales grow 7.6% during the holidays. So this is the Christmas period, but consumers turn cautious. So we've got some data here from MasterCard, and it shows that US retail sales rose 7.6% between November 1st and 24th. Now, the reason that they use these dates here is because this is the holiday season where you see a lot of the spending take place during the year. Most of the spending of the year is during this very short period of time here. Now, I do want to correct something that they're saying here, because all throughout this article and a lot of other articles, they're talking about this 7.6% rise. But actually that they're saying that sales rose 7.6% and retail has bounced back and it's a lot stronger. And, you know, they're using all of this sort of stuff. But as always, I just applied some logic and common sense here and really looked into the data points. And I would say that actually this is incorrect. So retail sales haven't risen by 7.6% in the last year, because inflation has also risen by a huge amount in the last year. So actually what you're getting is you're getting less amount of goods, but you're spending more money on those goods. So even with the 7.6% increase in spending, you're still not getting as many goods and services as you would have done. Now, I'm generalizing here because in some sectors, some areas of retail like apparel or some sort of clothing and things like that, you probably did get some better deals because they had excess inventory from all the supply chain breakdowns. And then some retailers that have got no stock, all of a sudden 2 or 3 ships arrive at once and all of their stock comes off, and then they've got too much stock, too much inventory. So yeah, you would have seen some discounts this year. But really what I'm trying to say is that it's not the way they're spinning it. So of course the media always spins it as, look at this is great, the economy is bouncing back, people are spending more money, people have got more money. No, as I'll show you in a moment, the data shows people haven't got more money as credit card and debt balances are rising. The article continues then, however, this year's holiday retail sales growth is less than the 8.5% increase last year as decades-high inflation, rising interest rates, and the threat of a recession turned consumers cautious. Retailers including Amazon and Walmart in the US offered large discounts during the holiday season to get rid of excess stock and bring back inventories to normal levels. However, sales of electronics dropped 5.3% over the broader roughly 2-month period, according to this report by MasterCard. So that's interesting that electronics actually dropped. But here we have sales in apparel and restaurants actually increased. So apparel rose by 4.4%. And again, I think that's just getting rid of excess inventory. People saw there was a lot of good deals to be had, so that's why they bought. But I must admit, the restaurants category being up 15.1% was somewhat surprising to me, because usually what happens in a recession, which is what we are in, but they're saying we're not, is that restaurants would see a decrease in spending. But at the moment we're seeing an increase of, and it's a very large increase as well. It's not a small increase here. So that tells me that either people are just putting it onto their credit cards, or they're putting it into debt, or that they just don't believe that we are in a recession, or that a recession is coming, or people are burying their head in the sand. I'm not really too sure what it is at this point. When we look at online sales then, these jumped 10.6% in the period, slightly less than the 11% increase last year. So what's Reuters saying then? Well, analysis. US stock investors face recession fears as they bid good riddance to 2022. A rough year for US stocks is winding down. I'm not too sure about that, but the market's pain may be far from over. And yes, I would agree with that in general, although I personally think that we're already in a recession and have been for quite a while. With only a handful of trading days left in 2022, the benchmark S&P 500 index is down 19.8% year to date. And actually, if we go over to my channel and you see the playlists here, here it is here. You'll actually see that 10 months ago, so this was back in February time, I actually made a video. That was quite a funny video where I got attacked by a dog, where I talked about why asset prices will fall throughout this year in 2022, which has been very, very accurate. So how did I know that? Well, not just because I've got a course here. I think a lot of you have taken the course now, the Ultimate Macroeconomics and Stock Market course. Really highly recommend looking at this course. Just reading through the information page here will tell you all about it. I mean, it is a beast of a course. I'm not going to lie here. It is an absolute beast of a course. But this will help you to understand pretty much how I make a lot of these forecasts here. Because the SPX is down 19.8% this year, and I personally don't see it recovering early next year. I know a lot of people do think that. A lot of people do think it's going to recover early next year. I just don't see it while we're in this tightening cycle. Because remember, what I talk about in the training course there is that we're not looking at fundamentals right now. What we're looking at is credit or creditism or liquidity. And that's what's driving these markets. Plus there's the fear aspect as well. So we have this perfect storm at the moment. We have liquidity being very tight, quantitative tightening, destruction of assets. We have higher interest rates. We have bad earnings reports. We have a recession that we're already in, but they're saying we're going into next year. So all of these things are very negative for the markets. Now, just a caveat to that is that there are so many different markets that what I'm saying isn't just a broad brush here. You've got to look at each market on its own. And you have like the S&P is completely different to the NASDAQ. They're completely different marketplaces. The same is true of, say, the FTSE in the UK, which has held up a lot stronger than the S&P this year. But just to give you an overall picture, I don't think that some of these analysts that are saying, oh, here we go, Santa Claus rally, and this year, January and February, massive melt up and new all-time high. I just don't see it, my friends. I just want to be honest with you. For those of you that, I don't want you to get sucked into the, all these CNBC and all the other stuff and the Jim Cramers, oh yeah, buy, and, all this stuff. I just don't want you to get sucked into that because I don't see what they see. The way I do it is very logical, very rational. It's looking at history. It's looking at charts going back 100 years to try and forecast what will most accurately happen. Continuing on, if a recession starts next year, stocks could be set for another swoon. A bear market has never bottomed before the beginning of a recession, historic data showed. Stocks perform poorly during economic downturns, with the S&P 500 falling an average of 29% during recessions since World War II, according to Truist Advisory Services. The index was down just over 25% in October from its January 3rd record closing high. So the consensus here that they're talking about earnings to rise about 5% in 2023, yet earnings fall by an average annual rate of 24% during recessions. Stocks generally follow earnings. Yeah, and again, I'll somewhat agree with this because it is all about liquidity. Just remember what I said, when you've got this really big tightening cycle and you've got high interest rates, I mean, this is quite complex. I won't get into all the different facets here, but you've got so many things that will pull the market downwards and squeeze it. Not to mention that if a lot of people do get squeezed with inflation and higher costs and they've got debt levels, they might also sell out of the market. But remember, for every seller, there must therefore be a buyer. But the prices might be lower if you have more sellers than you do buyers. You've also got, looking at the companies in general, the amount of debt that they've got. Some of the companies are very cash rich, but some of them are cash poor, and therefore they want to take on new debt. Growth, we talked about retooling last week, a lot of new R&D. All of this costs money, and that is usually raised in the form of debt, so borrowing. Well, with higher interest rates, that means higher borrowing. That hits earnings as well. There are just so many downside risks at the moment that completely outweigh the upside risks. Now, I did want to show you the Fed data here. So this is the official data from the St. Louis Fed. And we can see this is consumer loans, credit cards, and other revolving plans. We can actually see then how much consumers owe right now. And it's the highest since the records began here. And actually, before I zoom in a bit, what we've got is during the 2008 crisis, we had this rise in debt levels as well as people got hit by the recession here, and then they went down into this cycle of paying off debt. And then as times got better here, you can see how people just racked up their credit cards. But then again, what happened here in March of 2020, we went into another recession and people paid off the debt. Because why didn't this spike then? That might be the question you've got. Why didn't this spike if people got hit by a recession here? And the answer is it did a tiny bit. But then because of all the furlough and the stimulus, people weren't as badly affected. And a lot of people use the furlough and the stimulus and the benefits to actually pay down their debt, as they would have done later on in the recession. And then it has risen ever since, because this is a period here of higher levels of inflation. And as a result of this, what we're actually seeing is New Year's financial resolutions. Americans plan to take caution in 2023. So the name of the game is caution. 2/3 or 66% of Americans plan to make New Year's financial resolutions for 2023. However, the economic turmoil of 2022 is persuading many to approach the new year with caution. More than 1/3 of respondents said they're in a worse financial position this year than the year before. About half say they're ready to live sensibly or plan ahead, the survey said. And that is good to hear for my American viewers, because that's one thing I always talk about. Plan ahead. Don't just go crazy with the spending and racking up the debt and the credit cards, thinking that things are always going to be the way they are, because this is what happens. We do go into these cycles, and you can see how often they happen. We had one in 2020, although it was small. We're going to have one 2023, 2008 cycle, the 2000 cycle. These things always come up, but for a lot of people, they never prepare for a rainy day. They just assume that an object in motion is just going to continue on, and things are just going to keep getting better and better, and the government will just keep giving out more and more money. But that's not what happens when we go into a tightening cycle. Moving forward, 39% of respondents plan to save more money, 28% are looking to spend less money, and 32% want to pay down debt. Our economists call for a recession lasting 3 quarters, with a recovery penciled in for Q4 of 2023. Let me just interject here. I disagree with this. I do not see what they see here. I think it's going to be a lot more prolonged than just 3 quarters. And to say that we'll see a recovery in 2023 is somewhat pie in the sky thinking, in my opinion. What we'd have to see for a big recovery is a massive turnaround in the tightening cycle that we are currently in. But if we do see that turnaround, well, that's going to add to more inflation potentially later on all over again. And this is why I always say that the central banks are in between a rock and a hard place, because if they keep tightening, they crash the markets and assets, and therefore jobs lagging indicator comes later. Or if they go to loose monetary policy, then everything just blows up and up and up. And then we see what we've seen in the last 2 years, as well as the issues there are wealth inequality. So the rich getting richer and richer, the poor getting poorer and poorer and poorer. That leads to social issues, social unrest, and all sorts of other problems. So we are in a very difficult period right now. We are in the 4th turning cycle, and it is going to be very negative, but I don't want to focus on the negative today, because I realize we're still in the Christmas holiday period. So what else are we saying? As well as a significant unwind of the Fed asset base via quantitative tightening of 1.1 trillion over the next year. And I actually pulled up the chart here for you just so you can see the Fed asset sheet, so that their balances. And you can see what happened here in 2020. It exploded, and then it peaked around 9 trillion here. But ever since, they've been unwinding it 8.5 trillion. So they've unwinded about 500 billion from the asset sheet already, which we can see reflected in the markets and asset prices. So overall, an interesting 2022. I think we're going to have an even more interesting 2023 as we go through this new period of weak economic growth, a lot of problems in the financial world. My top tip to all of you is make sure that you are well educated on macro finance, and that you understand everything that's coming and what is most likely to come, so you can position yourself as well as you possibly can. I did mention my course earlier in the video. Also have the private community. You can look at what I'm invested in, if that will help you with your portfolio, with your assets as we go into 2023. Don't just rely on brokers and other people to, advise you. I think it's important that you do take on board your own advice. You do a little bit of studying here, not only because it will save you a fortune by learning a lot of the basics yourself, but just because it will help you to put you in a stronger position, take better control of your finances and money as we go into this next year, which will be quite a difficult period. All right, thank you so much for being a subscriber here. Take care. God bless. I'll see you tomorrow.